Hello and welcome back to the Note. Today I would like to talk about the crisis in the eurozone and whether it really is over, as I suggested in the long view over the weekend. Many people find that a little hard to believe, so I'd like to explain the terms on which we can say that the market crisis over sovereign debt in the eurozone is over. To start with, let's take a look at Greek government bonds. This is where the whole crisis arguably began when the incoming Papandreou government admitted that its budget deficit was much higher than people had previously thought. This is the return you would have got on Greek government long-dated debt over that period, and you can see that if you had bought those bonds just before the crisis ignited in late 29 and held them, you would at this point be sitting on a small profit. Yes, there's been a haircut in between, there's been an 80% fall in between, but plainly this is a very strong indication that the market has much more confidence that in Greek debt for the future. Now there's another way you can measure this, which is to look at spreads, the difference in the yields that investors demand from peripheral countries compared to core countries to compensate them for the extra risk that might be involved. This is a chart we showed you earlier this week comparing Irish bond yields with UK gilt yields. You can see that at one point the spread was up to more than 10 percentage points, a level that suggested a very high risk that Ireland was going to default, and that we're now right back to pre-crisis levels. Again, an indicator that the market believes that the crisis is over. Now, what the market believes is important, because what the market believes can be self-fulfilling in this environment. As we can illustrate for you if we take a look at this chart, which shows you Spanish government bond yields going back to 1999 when the euro was introduced. And you can see that the actual yield payable on long Spanish government debt is now at a historic low. Now that's very important, because that is the actual amount that the Spanish government has to pay to service its debt. If yields fall, that makes the problem itself much easier, just as a couple of years ago when the yields rose, the lack of market confidence in itself made the problem worse. Now, many people respond to this by pointing out that the European economy is still in very dire straits. You only need to look at inflation, which is now at only 0.5% across the whole eurozone, plainly with the risk of Japanese-style deflation there. You also only need to look at the euro, which is unnaturally high at present, which makes life very difficult for exporters. And of course, if you look at unemployment levels in countries like Greece and Spain, they continue to be at levels that really can only be called a human tragedy. But the thing is that the sovereign debt crisis itself was never really a crisis about the economy, it was a crisis about politics. We can illustrate that for you with this chart. What you're seeing here is the government budget deficit for the eurozone, expressed as a portion of GDP, compared to the other major industrialized economies, the UK, the US and Japan. And you can see that the eurozone entered the crisis with less of a budget deficit than the other industrialized nations, and it's now also still got less of a budget deficit than the other major industrialized nations. There has always been enough money in the eurozone as a whole to pay off, to service debts. The issue has always been, will the less indebted countries in the core of the eurozone be prepared to bail out the countries on the periphery, and will the periphery countries be prepared to accept the terms on which those bailouts are offered? As of 2 years ago, it seemed a very fair political bet that somehow or other the eurozone was going to have to break up. It didn't appear that the countries at the core were ready to bail out the periphery, and it looked as though the peripheral countries in many cases were going to reject bailouts on the terms that they were being offered. It now seems, however, as though those judgments were wrong. The Greek election of the summer of 2012 saw a majority of MPs who were prepared to accept the bailout. Then you had the statement from the European Central Bank that it would do whatever it takes to keep the euro intact. You obviously had German politicians similarly deciding that they wanted to keep the euro intact. And since then, the situation in the Ukraine, adding to geopolitical uncertainty, has made it all the more likely that politicians in the eurozone will do what it takes to keep the euro intact. None of this means that there aren't plenty more political risks in the future, or that the European economy remains in a dire state. But you can now see why the market decided that it no longer made any sense to bet that politicians would allow the eurozone to split up, and therefore you can see why it makes sense, quite remarkably, to say that at least for now, the eurozone sovereign debt crisis is over.